You could have a great overall credit utilization and still watch your score drop. And it all comes down to one card sitting too high. Most people only track their total usage, but FICO and your card issuers are actually looking at every single card individually at the same time. Today, I'm going to show you exactly how both types of utilization work, how to calculate them, and what you can do right now to get both numbers into the range lenders love to see. Let's start with the basics so we're all on the same page. Credit utilization is simply the amount of your available revolving credit that you are using at any given time. When we talk about revolving credit, we're talking about things like credit cards and lines of credit rather than installment loans like a car payment or a mortgage. Now, there are two types of usage, and both of them carry a lot of weight. The first is your total utilization, which is just all of your balances added up and measured against all of your available credit limits combined. The second type is your individual utilization, and that is the specific usage on each card by itself, one at a time. To make this easy to visualize, imagine you have a few different glasses of water sitting on a table. Your total utilization is how much water is in all the glasses combined compared to how much they could hold if they were all full. Your individual utilization is how full each single glass is on its own. And you have to remember that a lender isn't just looking at the whole table because they are checking every single glass. This matters a lot because your personal credit score treats utilization as roughly 30% of your total score, which makes it the second biggest factor behind your payment history. Within that 30% chunk, FICO is evaluating your total usage and each individual card at the same time. Your card issuer is doing the exact same thing when they decide whether to give you a credit limit increase or flag your account for being too risky. One more thing you need to understand before we go any further is that the balance reported to the credit bureaus is not usually the balance on your payment due date. It's actually the balance on your statement closing date, and those are two very different days of the month. Your statement closing date is when your billing cycle ends and your statement is generated. So whatever balance is sitting on your card that day is what gets sent to the bureaus. Even if you pay your full balance by the due date every single month, the bureaus might still see a high balance because it was reported weeks earlier when your statement closed. In a few minutes, I'm going to show you exactly how to use that closing date as a control lever. So you decide what the bureaus see, not your bank. Now let's talk about how you can actually calculate both of these numbers, because once you know how the math works, you can start using it to your advantage right away. To figure out your total utilization, the formula is actually very simple, and you can do it in about 2 minutes. First, you want to add up all the balances across every single credit card you own. Next, you'll add up all the credit limits across those same cards to see your total buying power. Once you have those two numbers, just divide your total balance by your total limit and multiply that by 100 to get your percentage. So let's look at an example where you have 3 different cards in your wallet. One card has a $1,000 balance with a $4,000 limit, while the second has $500 sitting on a $3,000 limit. Your third card has a $1,500 balance on a $3,000 limit, which brings your total balances to $3,000 against $10,000 in total limits. When you divide 3,000 by 10,000, you get 0.30, meaning your total credit utilization across your entire profile is 30%. For your individual credit utilization, you're going to use the exact same math, but you'll just apply it to one specific card at a time. If we look at that third card again, you have a $1,500 balance on a $3,000 limit, which comes out to 50% utilization for that single account. Even though your total profile looks okay at 30%, that one specific card is already in a range that's going to hurt your score. Now that you know how to run the numbers, let's look at the specific ranges you want to aim for to keep your profile strong. A 0% utilization is the absolute optimal goal because it shows you paid your balance down completely before your statement even closed. This is the strongest signal you can possibly send to a lender that you don't actually need the debt you're carrying. Anything under 10% is considered excellent, and it tells FICO and your bank that you're in full control of your available credit. If you're between 10% and 30%, you're in a good spot that won't tank your score, but it isn't the most powerful position you could be in. Once you cross over that 50% mark, the impact on your score becomes pretty heavy, and your card issuers might start watching your account a lot more closely. And here is the main thing to know from this section. The credit scoring models and your card issuers are looking at every single card on its own. If you have one card sitting at 80% while every other card is at 0, that one maxed out account is going to drag your score down regardless of your total average. The big picture definitely matters, but every individual card in that picture has to look good for you to get the best funding. So now you can see exactly where you stand. And once you know your numbers, the next step is knowing what to do with them. Let's talk about how to move both of these ratios in the right direction. So now that you can calculate both of those numbers, let's talk about how you can actually improve them starting today. There are 3 practical moves that work together really well, and the first one is setting a clear target for every card individually. Most business owners only think about their total utilization and they stop there, but you need a per card strategy if you want the best results. The goal is to keep every single card under 10% if you want to stay in that excellent territory that lenders love to see. While keeping things under 30% per card is usually acceptable, you really want to stay under 10% if you're trying to jumpstart your score or ask for a credit limit increase. The same rule applies to your total profile, where under 10% is the gold standard, and anything climbing toward 50% is going to start working against your funding goals. Now, this second move is something a lot of people don't know about, and it's honestly one of the most useful tips in this whole video. It involves your statement closing date, and once you understand how this works, you can use it as a control lever for your credit scores. Your statement closing date is simply the day your billing cycle ends and the bank locks in your balance to report it to the credit bureaus. Whatever balance is sitting on your card on that specific day is the number that shows up on your credit report for the next month. It doesn't matter if you pay the bill off 2 weeks later because the bureaus only see that one snapshot taken on that one specific date. So here is the move. If your statement closes on the 15th of the month, you want to pay your balance down to your target level by the 14th. By making that payment a day or two early, you ensure that when the bureau takes its snapshot, they see a much lower number. You aren't actually spending any less money, but you are taking total control over what the banks are reporting about you. Let's say you have a card with a $3,000 limit and you want to stay under that 10% mark we talked about earlier. That means you want no more than $300 showing on that card when the statement closes, so you'd make a payment a few days early to hit that goal. The bureau then sees a $300 balance on a $3,000 limit, which is a perfect 10% and keeps your profile looking clean. This one simple shift in timing can change your reported utilization overnight, and the best part is it doesn't require you to change your spending habits at all. You're just moving your payment date up a few days to make sure the math works in your favor. The third move you should consider is requesting a credit limit increase on the cards you already have in your wallet. This is a very straightforward strategy because if your spending stays the same but your limit goes up, your utilization ratio drops automatically. The math changes in your favor even though you didn't have to pay down a single extra dollar of debt. For example, if you have a $1,000 balance on a card with a $2,000 limit, you're sitting at 50% utilization, which we know is not a great look. But if you request an increase and the bank bumps that limit to $4,000, that same $1,000 balance suddenly only represents 25% of your limit. That's a massive improvement for your credit profile, and you didn't even have to write a check to make it happen. Most card issuers will be open to a limit increase once you've shown them 6 to 12 months of on-time payments on that account. Just keep in mind that while some banks only do a soft pull that won't hurt your score, others might do a hard inquiry. It's always a good idea to ask the representative which one it will be before you officially submit the request. One last thing to remember is that if you can't pay everything down at once, you should always focus your money on the card that is closest to its limit. Bringing one single card from 80% down to 30% is going to help your score much more than spreading that same money across 4 different cards. You want to knock out the worst looking card first to get it into a healthy range, and then you can move on to the next one. When you combine these 3 things, setting per card targets, timing your payments around your closing dates, and growing your limits, you'll have total control over your utilization. These are the most effective levers you have for managing your credit profile the right way, so you're always ready for funding. Total utilization and individual card utilization both matter, and now you know how to calculate and manage both. Before your next statement closes, Pull up each card individually and check where it stands instead of just looking at your overall number. If you want to see exactly what lenders are seeing on your credit profile right now, use the link in the description for a free pre-qualification review. And if this was helpful, give us a thumbs up and subscribe so you don't miss what's coming next. And next, watch this video on why good credit still gets denied. Because your credit score might be telling you one thing while lenders are seeing something completely different.